evening before. Okay, great. Great to have everyone here this evening. There's Ben Franklin said there's basically the two things that can't be certain in life, that's death and taxes. And we're here to talk about taxes tonight. In March, we're going to be doing our estate planning seminar, so we're going to be talking about death at that point in time. So, I always like to start off with something fun, and so here's a couple quotes. Quite a few of these are from Jimmy Kimmel. Jimmy Kimmel said, "Tax day is the day that ordinary Americans send their money to Washington, D.C., and the wealthy Americans send their money to the Cayman Islands." I'm not going to pay taxes. When they say I'm going to prison, I'll say no. Prison costs taxpayers a lot of money. You keep what you have to have. You keep what it would have cost to incarcerate me, and we'll call it even. When it comes to taxes, there are two types of people. There are those that get it done early, also known as psychopaths, and the rest of us. Yeah, I'll do a couple more. Regis Philbin's back in prime time, hosting 11 new episodes of Who Wants to Be a Millionaire? But because of Obama's tax plan, it's been retitled Who Wants to Win Just Under $250,000? And how about one more from Craig Ferguson? Another one of President Barack Obama's nominees is having tax issues, which proves one thing. The Democrats like raising taxes but hate paying them. So anyway, fun stuff. Now today we're going to introduce you to the different tax laws, kind of how taxes work. We're going to go through some illustrations on how we can implement them into our own tax planning. And then we'll also give you some educational ideas on how to reduce taxes on our investments and make money over time to increase the size of our nest eggs. So with that said, go the other direction here. The average refund check in this country in 2014 was $2,792 per recipient. So 110 million Americans received a refund check in 2014, which represented about $306 million was sent out in refunds. That's quite a bit of money. And so I don't know if this is the greatest tax plan to build up and try to get a refund from the government. It's always nice getting a refund check, but generally that's not really great planning if you're getting a big refund check back. Instead, you'd rather be investing that money throughout the year and have as little or no refund coming back. I was just working with a client this afternoon, and last year when she had her taxes done, she filed her return, and she found out that somebody else had already used her Social Security number to file her return for her and got her refund. And have you heard of this happening? Yeah, people are pirating Social Security numbers. And she said that the process is, as soon as you report it, after your file gets to an IRS agent's desk, then it's 180 days before you can even call them to ask them what's going on. So she said she's right around her 180th day right now, still wanting to get a refund from the 2014 tax season. So it's kind of a nightmare for her. I think they're going to probably stop. From what I heard, the IRS might hold back on those instant refunds or returns or whatever if you are getting a refund. Now, the wealthiest 20% of taxpayers pay 84% of all taxes. So the Taxpayer Institute has found that half, or roughly about 46% of people in America don't pay any federal income tax. And the wealthiest Americans, how you describe them, what do you think? What income level do you think that is to be wealthy in this country? To be in that top 20% that's paying 80% of the taxes? What do you think? 220,000? Okay. 150,000? How many people think $200,000 or more to be in the wealthiest? Okay. How many people think 400,000 or more? How about 100,000 or more? Yeah, it's actually $111,000. If you're at $111,000, you're considered to be in the wealthiest part of the taxpayer system. So 80% of the people in this country pay about 16% of our federal income taxes. So 80% pay only 16% of the federal income tax. The bottom 20% actually receive tax refunds and tax credits and don't pay anything in, okay? So that's kind of the way our system is set up right now, where it seems to work, where it's tax the wealthy, let's get the money from the wealthy. But there's a quote from Margaret Thatcher, you've probably heard this before. The problem with socialism is that you eventually run out of other people's money. So this won't last forever. Now, the tax burden, just as you heard in that song, there's federal tax, state tax, there's property tax, FICA tax, Social Security tax, Medicare tax, tax on beer and cigarettes, tax on everything you can think of these days. So the tax burden can really add up. So even the people that don't pay federal income tax, they're probably paying some other sort of tax, whether it's sales tax, property tax, or whatever it might be. So what we want to do is talk today about how do we reduce this tax burden. Dave Barry said it's tax time. I know this because I'm staring at documents that make no sense to me, no matter how many beers I drink. Yeah.
It's like those new commercials they have out where the tax guy comes to help somebody that's filing his own taxes.
Oh, yeah, yeah.
He's putting water in his swimming pool.
Right.
And he's like stumped, and he says, well, did you buy a house last year?
Yeah.
Well, then hit that.
Yeah, click that. Yeah, that is a good ad, yeah.
Oh, I don't know what to do.
Yeah, yeah, that's a TurboTax ad, yeah. It's just like click through it. That is pretty good. Impact of taxation on returns over time. This study was done over a long period of time by Morningstar, 74-year period. Stocks have averaged 7.7% on an after-tax rate of return. And if you look at stock averages over that long period of time without the taxes, or if you're managing them tax efficiently, it's closer to 10% rate of return. And so the government is always standing there. That's your biggest expense when you're investing, is the government saying, okay, well, we want 25, 30% of everything that you grow your portfolio to. And so what we really want to focus on, well, how do you make your portfolio more tax efficient and give less to the government on a year-by-year basis? The rules keep changing. Since 1940, there's been 80 different rule changes. And every administration that comes in has something new and better going on and great ideas. But the book on taxation just gets thicker and thicker, and it gets more difficult, it seems, all the time. So whenever there are new rules, what we want to do is make sure you stay brushed up to make sure you're taking advantage of everything on a year-by-year basis as the changes come through. So we're going to go through three main areas. We're going to talk about how your income taxes work. We're going to next talk about tax-favored investing and saving strategies, and then we'll talk about some tax planning ideas and opportunities. Basic formula for determining income taxes: we take your gross income, less adjustments, where we arrive at your adjusted gross income. From there, subtract out deductions, exemptions to come to our taxable income. I'm going to zoom in on this a little bit. I wonder if this will zoom. This doesn't zoom. So do you guys have this one slide in your handouts, or did I just have this on my overhead? I think I just have this on in the slideshow up here. So if you're familiar with a 1040 federal tax return, basically this first section you fill out is on your income. And your income would include wages, salaries, tips, things that you receive from your W-2 income. And then from there you would add in taxable interest, your dividends that you're receiving, capital gains on your investments, business income, could be farm income, pension, annuity distributions, IRA distributions. There's a line item here for Social Security. Social Security is calculated in a different way as income. It's called provisional income, and I'll talk about that a little bit later. And then you would add in unemployment compensation is taxable. So all these areas that you're receiving income would tally up to line 22 as your total income. From there, you subtract your adjustments, and adjustments, the most common one would be health savings account pre-tax adjustments, or if you're maybe making IRA contributions. And then bottom line on the front page of your return is where you come up with your adjusted gross income, okay? So adjusted gross income kind of drives some of the tax benefits that you'll be having. Second page of your federal return is where you get into your deductions and tax credits and you figure out what your taxable income is. So from there, you're going to be looking at your itemized or standard deduction. So an itemized, you can use either or. So the itemized deduction would be things like property taxes, safety deposit box, medical and dental up to a certain amount. It has to exceed 7.5% of your adjusted gross income.
Car licenses.
Car tabs, charitable contributions would be itemized deductions. Property taxes, interest on your home mortgage, if you still have a mortgage. What are some other ones that we might be missing here?
Job searching expenses.
Job search expenses,
Sales tax on new cars.
sales tax on new cars. What's the biggest one that I haven't heard yet? That if you're working and you're paying state of Minnesota taxes, yeah, so you can deduct that on your federal return, whatever income tax you're paying on your Minnesota side. So you add up those deductions, and if they exceed your standard deduction amount, then you'll itemize instead of taking a standard deduction. And I think for we'll go look at the tax tables here in a minute, but I think it's 2015, it's $12,400 for your standard deduction for married filing jointly. I'll look at that in a second. So you subtract out that as a deduction, so that comes off of your income before you pay your tax. And then from there, you can also subtract off your personal exemptions, okay? Personal exemptions, it's $4,000 per person. And then if you're over age 65, it's an additional about $1,000 for over 65.
No, that only affects the standard deduction.
For the standard, okay.
65, you get a greater amount.
Okay, so if you're taking a standard deduction, then you can take additional.
Yes.
Okay, if you're over age 65. And I have another graph that'll show that. So you take your deductions and your exemptions, subtract them off your personal income or your taxable income, and then we go to the tax charts to figure out how much tax you're going to owe. So what we're looking at is you'll write this down, line 43 of your tax return. So when you get home or when you're doing your taxes this year, look at line item 43 because that's your taxable income, and your taxable income will determine what bracket you're going to fall in. And it's a graduated bracket. So the first, for single individuals, the first amount of money up to $9,225, it's at a 10% tax rate, and any incremental dollar of taxable income over $9,225 but below $37,450 is taxed at a 15% rate. And then once you're over the $37,000, then it goes into a 25% bracket. So it's a graduated tax bracket. Married filing jointly, you can see that the 15% bracket is between $18,450 and $74,900. So if you have taxable income of $50,000, what bracket are you in at married filing jointly? 15, right. If you're single, if you have taxable income of $50,000, what bracket are you in? 25, okay? So now these brackets, what the important thing about knowing these is when you're drawing or taking income from, especially for retirees, example, earlier this week I was meeting with a couple and they had just roughly $30,000 of pension income coming in and $30,000 of Social Security income coming in. So that's $60,000, okay? Everybody follow so far? When you go to the front page of the 1040, Social Security isn't taxed fully because it's considered to be provisional income. And so when we looked at their adjusted gross income, it was $45,000, not $60,000. And so you go to the next page, they had a couple of personal exemptions, and they had a standard deduction, which amounted to about $20,000. So 45,000 less 20,000 of deducts, their taxable income fell at 25,000. So they're in a 15% bracket, right? So what we calculated is they could take up to the $74,000 level and still be in a 15% tax bracket. And if they're in a 15% tax bracket and they're making decisions on where to draw portfolio income from to supplement their retirement, we know that if they take it out of their IRA account or 401k, it's taxed at a 15% federal rate. And then once they go above that 74,000 mark, then it's going to be taxed at 25%. So we want to know these thresholds because then you can start to go, okay, well, what should I draw it out of? Another example, earlier this week, last night, meeting with a couple that's retiring this year. They're selling their restaurant, and their plan is to they're going to fly to they're flying to Sweden to buy a Volvo. Remember we talked about this not too long ago? So, excuse me. Could you do me a big favor and grab me a water from the fridge? Thanks. Not a beer, Wayne. Later. So they're going to fly to Sweden to buy a car. And have you guys heard about this? So if you buy your car, your Volvo in Sweden, Volvo will fly you there and pay. They'll pay for your air tickets and for 2 nights stay. And then you buy your car, and then you can drive it around Sweden, Europe, Scandinavian countries, Europe. And then you leave your car there, fly home, and they ship your car to you, and it's no longer a new car, it's a used car, so the sales tax is lower, import tax. And the import tax is low enough where Volvo says, okay, we'll pay for your airfare and pay for your couple nights stay.
How many miles do we have to drive to make it 0 or 1?
I don't know how many miles you have to drive, but I could get that answer from somebody that's done it. So they actually met with my client that did that. Remember Ken, he was here at the last, so they met and had lunch with them and they planned out their trip. So they're going to do 2 months over in Europe driving their car around. Sounds like a nice way to start their vacation or their retirement. So for them, they said, well, we're going to need 20,000 additional out of our portfolio to make this happen. And we all, because they're working hard this year, we know that their bracket is already here. And if they take money out of their retirement accounts, it's going to be taxed pretty heavily on the federal side and the plus, you got to remember, this is only federal tax. State of Minnesota is another 8%. And so what we calculated, it's best to take it out of their mutual funds that are not in a retirement account to pay for the car. Some calls I've been getting in the last few weeks, it seems like we get a lot of, General Motors and Ford had their most sales ever in history here in the United States and in China. You know what the #1 selling vehicle in the world is right now? Ford F-150 pickup truck, okay? So recently we've been getting calls about, okay, we're buying a car, we need $40,000 from our portfolio. And my response is, well, can you wait and leave the money deferred for a little bit longer so the market has a chance to rebound? Because, when the market's down the way it is, maybe you want to buy yourself some time, take out a loan, and the loan interest rates are pretty low right now. Just pay monthly, and then, oh, there's Ken right there, talking about Volvo. I didn't even see you here. Do you have to drive a certain number of miles?
No, it doesn't matter.
Doesn't matter.
You just have to drive it.
Drive it off the lot.
Yeah, you can drive it around the block if you want.
He's the guy to talk to after about cars. But yeah, so that's something to consider. When lump sums out a portfolio, if the market is having volatility, maybe you wait sometimes. Maybe you use loans and those types of tools. So know your bracket. Look at line 43. Know where you're sitting in this scheme of things, and then that'll help for making investment distributions. Here's 2016 tax brackets. This is important for this year, moving forward. And then, of course, in the very back page, on the very back page of your handouts, there's a sheet that will talk about the annual limits for 2016. So 401k contributions, $18,000, plus if you're over age 50, $6,000 catch-up, so you can put in a maximum of $24,000 into 401ks for over age 50. IRA contribution limits are back there. The other thing that's interesting on this chart is it'll tell you what your Medicare premiums are, Medicare, Medicaid, and those can be different depending upon your income level. So that's something that's fairly new, where I have clients that are retired and they're watching their income sources, because if you're taking too much income, then your healthcare premiums are going to start going up because of that. So check that out. Talk to your healthcare person or health insurance person. The back, or the flip side of the page, I have the tax schedules, the brackets, education ideas for lifetime learning credits, et cetera. And then also we have on there the exemption amounts for 2016. The personal exemption went from $4,000 up to $4,050. Yay. Now, some of the other details, this doesn't affect a lot of people, but it can. If you have your personal exemptions and you start to notice when you're doing your taxes, it doesn't look like you're getting a full deduction. If you're single and your income's over $259,400, they may be phasing out the deductibility of your personal exemptions. For married filing jointly, your your personal exemption starts to phase out when you're at $311,300. And then the other area that you could be losing deductions, if you're single and if your income is over $259,400, then you're going to start to lose your itemized deductions. And for married filing jointly, it's $311,000. Okay, so those people can't take as many deductions as folks that are under these amounts. This slide here I think is really key. It talks about capital gains and dividends and how they're taxed. And it says here that your capital gain tax rate, if you hold an investment for under 12 months and the investment goes up in value and you sell it, it's taxed as ordinary income, the gain on it. But if you hold it more than 12 months, then it's taxed as a capital gain. And it says the maximum tax rate is 20%. Now, if you're in the 15% bracket, your 10 or 15% bracket, your capital gain tax rate is 0%. And so what you want to pay attention to is that you're trying to keep yourself in that 15% bracket when you're taking capital gains on your investment portfolio. And that's not much of a problem right now, but someday, but no, just kidding. So for couples, another example would be, one couple is working with, we know the threshold is about $74,000 that you could take in income before you go up to, or taxable income before you go into the 25% bracket. So going back to that earlier example, I said this couple had $25,000 of taxable income. They could take an additional just roughly $50,000 of capital gain, and there's no federal income tax on it, just state of Minnesota tax. So if you know these brackets, then you can start to take advantage of really low tax rates. Same for dividends. The dividend tax rate is very low. If you're in a 25% bracket, the dividend tax rate is 15%, not 25%. The only people that pay 20% on capital gains and dividends would be those that are in 39.6% bracket, which your income has to be pretty high to be up there. Okay? Questions? The other kind of the flip side of capital gains is capital losses. So capital losses are something investors can take advantage of outside of their retirement accounts. So if you have an investment, let's take an example, an investment that starts at $100,000. And if the investment goes down to $90,000, let's say it's in a stock, you could sell that investment and then reinvest in something else, another stock that's not the same stock, but could be a similar stock. So then you sell this investment, get into another investment, so therefore if the market goes back up in value, which over time historically it does, you're not seeing that market growth. But in the meanwhile, you've now realized a $10,000 capital loss on your investment. So that capital loss you can use to offset future capital gains, or you can take that capital loss to offset up to $3,000 of ordinary income each year on your tax return. So it's like a refund from the government when you take a capital loss and use it against ordinary income. So on a $10,000 investment, it's like getting $3,000 back from the government when you're using it this way. So when there's market downturns, keep in mind, to look at the investments, and we do this for investors. We look and we go, okay, well, let's go ahead and take this capital loss. It's on paper. Now we've taken it off the paper. We put it on your tax return. We're still in the market. We can always go back to that investment after 31 days have passed, and ride the investment or get back and the same thing long term. Make sense? Okay. Moving on here. Social Security benefits can be taxed, and so oftentimes people retire and they start drawing their Social Security income, and then they go to do their tax return the first year and they go, oh wow, I was expecting $2,000 a month from the government, $24,000 a year, and they gave me that full amount. And now I went to my tax advisor, and he said that I owe $500 a month on that $2,000 of income. So I owe $6,000 of taxes on my Social Security. So people don't realize that Social Security can be taxable if you're in these threshold brackets right here. And this is what we call provisional income. And provisional income, what they do is they take your income sources from the first page of your tax return. So just add all those things up, and then that line item where it says Social Security, only half of that. And so take half your Social Security plus all the other income coming in, and that will give you your provisional income amount. So when you start to exceed these thresholds, then the IRS says, okay, we're going to tax your Social Security benefits. So sometimes you can work with the numbers and figure out ways of drawing from your investments where you don't have to pay tax on Social Security. So you might, for example, take your required minimum distributions. The first time you have to do it, take 2 minimum distributions in 1 year instead of spreading it out over 2 years, because that way you might stay in a lower bracket and avoid the taxation of Social Security. So there's some tricks that you can use to stay away from this tax or to avoid it. And we're talking about tax avoidance, not tax evasion. Everybody knows the difference, right? 15 years. And Stillwater Prison. What does your tax return say about you? You can look at Form 1040. Again, try to find line 43, as I mentioned before. Try to itemize on your taxes if you can. Try to bring your taxable income down with pre-tax investments. When you look at Schedule B, which would have your interest, dividends, and capital gains, ideally here you want to try to have qualified dividends because those are taxed at lower rates. You want to have capital gains and stay in the lower brackets because there might not be tax on them. So again, have somebody look at those for you if you haven't done it before. G. Leno, worried about an IRS audit? Avoid what's called a red flag. That's something the IRS will always looks for. For example, say you have some money left in your bank account after paying taxes. That's a red flag. Let's talk about tax-favored investing and savings. So a couple different things here. There's tax-exempt investments and there's tax-deferred investments. Tax-exempt investments, example would be municipal bond funds. Tax-deferred investment would be 401ks, IRAs, annuities, life insurance are tax-deferred. The municipal bond market is very large. There's state local governments, basically they're issuing debt. On average, there's $8,466 owed per individual in America back to municipalities. I think, what is the federal debt per person? Isn't it like $80,000 per person? Something in that ballpark, it's up there. So every man, woman, and child in the United States owes that much in debt. So muni bonds, why people like these, you can buy them as individual bonds or you can buy them in bond mutual funds. And so muni bonds are designed for, they're a very safe investment. They're kind of the lowest risk or one of the lowest risks on a risk spectrum scale, where they're designed to pay maybe 2, maybe 3% interest. And when you receive this interest, so let's say you're getting 3% interest on your money from the muni bond. If you're in let's say you're in a 33% tax bracket, so you have 25% federal and another 7% state, let's just say, or 8% state. If you were earning 4.48% on a normal investment, it's the equivalent of 3% after taxes. So the higher your income tax bracket, the better these muni bonds work in your portfolio. And so they're also very, stable, very safe. Like when the stock market goes down, the muni bond market goes up. So they're just kind of a holding place that we see investors and recommend investors use. Municipal bonds. Yeah, muni. Yeah. So there's Minnesota municipal bonds. If you live in the state of Minnesota, if you have Minnesota municipal bonds, they're state and federal tax exempt. Qualified retirement plans, there's traditional IRAs. For 2015, you can put in $5,500 pre-tax, or might even do a non-deductible IRA. $6,500 if you're over age 50. You can contribute to your IRAs all the way to April 15th of the tax year for the prior tax season, for the prior tax year, okay? Tax filing deadline date is April 18th of this year, not April 15th, because April 15th is a holiday. 401ks, it can just ruin your weekend and doing your taxes. 401k, 403b, contribution limits $18,000, 24 if you're under age 50, $24,000 if you're over age 50. And the importance of investing on a pre-tax basis, if we have an investor that's putting $1,000 away into a pre-tax investment, the full $1,000 goes to work. But if you wanted to invest after tax, and if you're in a 28% tax bracket, well, you have to have $1,389 just to get $1,000 into that investment. Because again, the government's always standing there and saying, okay, we want a third of your money. So if you can put the government's money into your retirement plan and let it compound over time, you've seen these examples before, that you'll have a lot more money in these pre-tax, tax-deferred plans than you would in the after-tax plans. So take advantage of pre-tax, after-tax investing any way you can, okay? Max out those things first. Any questions there? And I won't spend a lot of time on these because you've heard this many times before. Other tax planning opportunities? Yes, question? Question is on muni bonds. I think I could hear it. So if you live in Wisconsin or if you have a bond from Wisconsin. Okay, yeah. So if you live in Minnesota, but if you have a bond from another state, it's federally tax exempt, but you have to pay Minnesota taxes on it. Okay. If they're all Minnesota bonds, there's no Minnesota tax, there's no federal tax. If you live in Wisconsin and you have a Minnesota bond, you have to pay triple income tax. No, I'm just kidding. You should have to. Packer tax, there you go. Going back here, we'll just leave it at this slide here. So contributions, IRA versus 401k. They both are pre-tax, so always you want to invest into your 401k first up to at least the employer match. You know, that's pretty obvious. And then after that, if there's different income parameters where on that one tax chart that I gave you, typically if you have an employer-sponsored plan, you cannot do a pre-tax IRA on your own. Okay, they're just not allowed. If your income is below, I think you can look it up, it's like $50,000 for a couple, then you can do your 401k plus you can do a pre-tax IRA. Okay. Now, if I have one of my clients, they're really high income earners, and they max out their 401ks every year, and then in addition to that, they do non-deductible IRAs. So they both put in $6,500 into a non-deductible IRA. So they can't write it off on their taxes, but then when it goes in their IRA, non-deductible IRA, and that's a good thing. So for people that, just one other little thing you could do, if you don't have an IRA right now, and if you want to do a non-deductible IRA, there's some people that, you know, I'd say, okay, do a Roth IRA first, because then, you know, you can't deduct it anyhow, then it grows tax-free forever. But if you can do a Roth IRA because your income exceeds, I think it's $175,000 for a couple and $100,000 for individual, then you could do a non-deductible IRA, and then we usually say wait about 6 months, then convert it to a Roth IRA, and then that way you can get around those income limitations. Okay. If you have a non-working spouse, your non-working spouse can do a pre-tax IRA. If they don't have an employer-sponsored. Yep. Does that help, Jim? Okay. Yeah. Any other questions on that?
You have to have earned income.
Yeah, that's a good note on that. To do IRAs and Roth IRAs, you need to have earned income on that first page of your tax return. So if you have $4,000 of earned income, you can only do a $4,000 IRA contribution. If you have $6,500 of earned income, if you're over age 50, you can do the full $6,500. And you could do one for your spouse too, even though your spouse might not have earned income. Herb.
How about if it's like interest and dividends and that you haven't, can you add it to?
Yeah, that's kind of a tricky thing. So if you have interest and income from your portfolio, dividends, capital gains, Social Security income, pension income, that doesn't qualify as earned income. Earned income is, just think about it as working income. So if you have like a dividend from a lease on a farm or something like that, that doesn't count toward, you can't use that toward your IRA. Yeah, Tom.
I found that was interesting is after retired, if you're taking stock options,
Uh-huh.
they're earned income.
Yeah, that's an interesting area for people that might have stock options that they're realizing or that earn the money after they retire. As those stock options, as you cash those in, it is counted as earned income, so you have to pay Social Security tax on it. However, one of the things you got to remember is if you're drawing your Social Security benefit, if you're using TurboTax or your own software program, the TurboTax, what they'll do is they'll say, okay, you had a stock option. The stock option is going to be reported to Social Security Administration saying that you had earned income that year and that you are over the income thresholds, and then they're going to take your Social Security away from you.
Careful how much you
Well, the thing is, there's a kind of a technicality in the law that if it's a stock option, non-qualified stock option, then they cannot take your Social Security from you. So we'll run into taxpayers every now and again that have had their Social Security taken away from them because they have the stock options, but then you just go back to the IRS and say, oh no, it's a stock option that I earned when it's working, and I'm working right now. It's pretty crazy. So we've had people that could get 5 years of their Social Security money back. Yeah. And they're just, because they didn't, they're doing their own taxes and they don't want to get it checked by a tax person. Yes. Because, or the question was, why haven't these contribution limits gone up for IRA accounts? Remember, it used to be $2,000, and you only really see them go up when there's, a new administration that comes in and says, okay, we're gonna, rework the tax laws again, and we haven't seen that for a while. Yep, okay. Well, let's move on here, and we'll talk about tax planning opportunities, tax-free exchanges, stock and bond swaps. If you have highly appreciated stock, if you're a certain net worth, you can actually exchange that stock for a basket of stocks, not pay tax on the stock that you have. The stock and bond swaps, to qualify for that, you have to have a $5 million net worth. Otherwise, it's just not allowed. So not a lot of people just don't have that in net worth.
I probably wouldn't be sitting here.
What do you mean? Most of these people here, you're the millionaires next door. Hasn't Tony told you? Yeah. So the 1035 exchanges, that's if you want to move an insurance product, one insurance product to another insurance product. So if you have an annuity or life insurance product, it's like an IRA rollover. So you can go from insurance company to pay tax on the money. It stays tax deferred. U.S. Treasury securities have tax breaks. Obviously, charitable contributions reduce your income. And this area here is interesting. If you're retired and you're using the standard deduction on your tax return, so if you do a charitable contribution, well, you can't itemize it anyhow. So one idea here is that when you're 70 and a half, you have these things called required minimum distributions. So you're taking money out of them and paying tax on them. So with these RMDs, you can actually direct them so they go directly to a charitable organization, and then it doesn't show up on your tax return. Because if it shows up on your tax return, the income from the IRA, then it might create taxes on your Social Security benefits. And so it's just a way that we'll see retirees. I might have a retiree that says, okay, I want $1,000 to go to my church. I want $1,000 to my alma mater. I want, 1,000 here, 1,000 there. And we'll have that RMD go directly to the 501c3 nonprofit instead of right to that person's bank account, because they're gifting it out anyway. Appreciated assets could be donated, and we saw a little bit of this going on last year where Medtronic went through the inversion with Covidien, and so people could gift their shares of stock to a charitable organization. And it was pretty interesting because then Medtronic would match the gift with whatever was, given. And so if you have stock or things that have gone up in value, take a look at your corporations to see if they do a matching program. Homeowners, if you're purchasing or refinancing a home, selling a home, you can also do a like-kind exchange. Remember to tell your tax person or enter it into TurboTax that if you've done home refinancing, there might be points, there might be things that are deductible. And then if you're selling a home, if you're single, you can take up to $250,000 a gain without taxes, $500,000 for married filing jointly. You can do this every 3 years as long as you're residing at the place. So we'll see people that might have some appreciated farmland, for example, and they'll make that their primary residence until they sell the farm, and then they can be tax-free. So think ahead on this a little bit. It's not only it's not a one-time thing. It's something you can use every 5 years in your planning. Like-kind exchanges. Here's what we call a 1031 exchange, not a 1035 exchange. So if you have appreciated property, you can take that property like farmland, for example. If there's a lot of capital gain on it, you might say, I'm going to take that farmland and swap it for a commercial office building. And then so you don't have to pay tax on it. And you just have to find another business type property and then there's no tax, so you have a lot more money invested in the long haul with these 1031 exchanges. What if you get audited? I would highly recommend if you get audited, not just an inquiry. You know, a lot of people, you get these letters from the IRS, they just say that are pretty like, okay, well, that makes sense. I just want this information. But if it's a full-blown audit, the best thing to do is have a good tax person, have somebody like Eric, have a CPA, have somebody go to that audit or help you with that audit. Because what we have heard about audits is they might ask for one thing, and then you get more than they need, and then they get digging, and pretty soon they're looking back over the last 5 years' tax return where they didn't even care about that, but you've shared too much information with them. So just, if you're in the audit process, hire a tax person to help you through it. The state of Minnesota hired something like 200 new tax auditors, you know, to try to find new revenue, and they're aggressive with trying to find new revenue in that area. One of our tax accountants, he said that they have like a dozen audits going on right now, and he said last year out of the dozen audits they closed, they never paid a single penny to the state. Said the state was wrong in every single situation that they've had so far. So it can happen. They hired more, yeah.
Get any money out of that?
Yeah. Okay, so how can you manage your taxes? Understand how income taxes work. Practice tax favored investing and saving. Utilize tax planning opportunities. Where you go from here, we have a lot of people that do their own income taxes. Feel free to, when you come in for a review, or if you want to have a financial plan done, bring those tax returns along, because I double check them. You know, we can look at them, we can say, okay, yeah, you know, have you thought about this, or you might be missing this. Eric will review the tax return if you have questions on things, so we oftentimes do that. If you want to work with your tax accountant, that's great. If you work with our tax accountant, if you have accounts with us, we have access to all the 1099s and everything, all the investments that come through here. So sometimes that makes it a lot easier for individuals, because then we can say, okay, well, you know, where is that statement? Why isn't it come in, and so forth. One thing I'll make a note on is when you're doing your tax returns, be careful not to get too anxious to get them done on like February 1st. Because a lot of the 1099s these days, they won't even come out till mid-February, sometimes till mid-March. And so you got to be patient, because what happens is the investment companies have to tally up all the reports that mutual fund companies and REIT companies and bond companies are sending to them. And then they get all this information, and they have to balance it out and then send it out to you. And if one company makes a correction, then they have to redo all those 1099s for everybody that has that investment. So that's why we're seeing the 1099s are coming out a little bit later every year. So I'm just saying, okay, if you're just kind of think about, more. Okay. If you need help doing your tax returns, as we mentioned, Eric has been doing tax returns for over 30 years. He managed the largest H&R Block office here in the Twin Cities, down in Bloomington. Does a great job. Cranks out the returns. He actually, the pricing, how much it costs to have your tax return done, he actually prices so it's a little bit lower than H&R Block. Is it?
Oh, definitely.
Yeah, so it is lower cost than what you get at H&R Block, with a lot more experience from your tax person. And average return, what kind of ballpark do people pay to get returns done these days? About $180 to have a professional do a tax return. If there's additional things, calculate the basis of tax or stock and those other things, then obviously it could be more than that. Dave Barry, and you taxpayers out there, file your tax return on time, and remember that even though income taxes are a pain in the neck, the folks at the IRS are regular people just like you, except they can destroy your life. So next month, we have, we're doing webinar only for our monthly workshop. And our guest speaker for our webinar is a man by the name of Bill George. You might recognize his name.